Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. Boy, what a U-turn the market made today. Tech was just diving and diving and diving. The NASDAQ was down, down, down. And then we had buy the dip opportunity. A lot of investors thought the market was oversold and bought the dip. And then we saw stocks starting to rise, especially technology stocks. So we're going to get into all that. I've got a few stocks I want to dive into, like Lululemon. A lot of retail stocks came out today. A lot of retail companies came out today and lowered their guidance, downgraded their guidance. So that wasn't too good. Like Abercrombie and Finch, they just came across the wire. They downgraded their guidance on the year. They expect revenues to rise 4 to 6% year over year, which is down from prior guidance. So we're going to get into that. Also talk a little bit about generators and power walls. That's an important topic at this moment in time. But the most important thing is what's on your mind. If you have a question, leave your ticker symbol and question in the comments, and we will go over it live during the show. So while you're doing that, I'm just going to jump right into it. So the growth and value stock divide, it expanded last week. But today, it's important to note that value cyclical stocks, they headed lower also, as investors look to de-risk in mid expectations for further downside. The Russell 3000 Value Index was down 1.1% today. Last week, the Value Index, it rose 0.5%, while the Russell 3000 Growth Index, it sunk by over 4%. So in our current environment, wouldn't it be great to know what the top 10 stocks are in categories like value, growth, dividend, and momentum? Well, great news. We just uploaded our top 10 stocks list for each of those 4 categories. That's over 40 high quality stocks ready to choose from a list that is constantly updated. So at the beginning of the year, we came out with our list for those 4 categories. Today, we just updated a few of those lists because as the environment changes, as the market evolves, our lists constantly evolve with the market. So you always have the best names available. So click the first link in the description and become a member, and you get instant access to our top 10 value, growth, dividend, and momentum stocks, and so much more. We've done the research so you don't have to. Okay, stocks started the week on a negative note. The Dow Jones, it fell more than 150 points, a 4th straight session of losses, while the S&P 500 slipped 0.1% for the day, a 5-day losing streak. Meanwhile, the NASDAQ was little changed, falling more than 2.5% at the beginning of the session to end in the green, nearly flat. Treasury yields continued to jump to levels not seen in 2 years amid prospects of higher interest rates, as the odds of raising that Fed will raise its rates, the Fed fund rates, maybe even 4 times instead of 3 times this year, as central banks signaled earlier. Investors also await the all-important inflation report. The confirmation hearing for Fed Chair Powell and speeches from several other policymakers for more clues on the Fed's timing for its Fed funds hike. On the corporate front, earnings season kicks off at the end of this week with big banks reporting like Wells Fargo, Citigroup, and JP Morgan, all reporting on Friday. We actually talked about 2 of those, JP Morgan and Wells Fargo, in our Catalyst Watch video from yesterday evening. Now, investors started to buy the dip sooner after it looked like the 10-year yield peaked for the day, finding a good excuse to buy into an oversold condition in the market. The NASDAQ, for instance, was down 8.2% in its lowest point of the day in less than 5 sessions. So in 5 sessions total, at the lowest point of today, all 5 together, the NASDAQ was down 8.2% for those 5 sessions combined. and had fallen below the 200-day moving average, which was at 14,690. The S&P 500 couldn't reclaim its 50-day moving average at 4676. And you see on your screen here, this green candle all the way to the right, that's today's candle. Now, the wick goes all the way down to a low of 4582, but it closed at 4670, just below, 6 points below the 50-day moving average, which we talked about in the Catalyst Watch video from yesterday evening. A simple phrase to help you remember when you're investing: bullish above, bearish below when it comes to the 50-day moving average. With the S&P 500 sitting right there on that 50-day moving average, we're kind of in between. We could go bullish, we could go bearish. We went bearish this morning for sure. All right. Now, 8 of the 11 S&P 500 sectors still closed lower. The industrials, they were down 1.2%, and materials were down 1%. Those were the sectors that declined at least 1%. While the healthcare sector advanced 1%, pretty good. They advanced 1%. Evidently, cyclical stocks were lumped into the selling activity today, like I mentioned at the very beginning. Besides downside momentum, risk sentiment in the space was pressured by a report from the Washington Post that indicated that Senator Manchin, Democrat from West Virginia, is no longer interested in passing any legislation resembling the Buy Back Better Act. Whether that's good or bad, it's not for us to, not for me to discuss here. All right, let's look at Bitcoin, BTC, USD. Let me get my cursor right. On TradingView, and there is a link in the description below for a free account to TradingView. Now, Bitcoin, we talked about in the Catalyst Watch video last night. I'm going to remove the volume here for a moment. We had a big candle today for selling, but what I want to focus in on is this trend line here. Now, if you notice here, this black trend line right here, it's an ascending trend line. Now, for Bitcoin, for the past 4 days, it has been closing above this trend line. Now, the wick of each candle is going below the trend line, and today it got as low as 39,650. 39,650. It broke the $40,000 level. And I was talking about that yesterday. The $40,000 level is very important right now. And I believe that a low, maybe 40,000, maybe as low as 39,000, like it did today, 39,650. I really have this feeling that this could be the low point for Bitcoin. And maybe we could get a turnaround or bounce off of this. Now, the candles themselves are not very big. I mean, look at the past 3 candles. The price isn't moving that much. The wicks, though, they are moving a little more substantially, especially today with that big dip this morning. Now, with that dip this morning down to 39,650, that was a buy the dip opportunity, in my opinion. Sorry, something just loaded there all by itself. All right, so if Bitcoin can hold along this trend line here, that's positive for me. Now, it's below all of its trend lines, and it's just kind of hanging out right here. And this is, for me, a line in the sand moment. If it dips below this 39,000, 40,000 area, then I think it's in real trouble, real big trouble. Because if we go look at this in a bigger view, change our perspective here, you can see that Bitcoin, look back here in July of 2021. It got down to this point, this bottom trend line, and that's where it made its reversal. Now here, The wicks are coming just below this trend line. Can it stay above it? And maybe we get a reversal here. That would be very positive if that could happen. And then we can go back here. I think my head's a little bit in the way on this one. Back here, October of 2020, that was another turnaround spot when it hit the bottom of this trend line. Now, of course, the moving averages at that time were still, price was above them. So it was a positive and a bullish structure. But now we don't have that bullish structure right now. We're just holding on here. And quite frankly, I'll put volume back in here. Volume has been pretty low the past couple of days. Today was a little bit different. Today, volume was 23.5 million, with the average being 15.7 million. But yesterday, volume got down as low as 11 million versus, remember, today's 23 million. So volume over the weekend was really low, but there were people buying the dip. Whenever it got down into the low 40,400, 40,300, people were stepping in and buying the dip on that. All right, so that's a positive in my view. Today, though, it's a red candle. It is down, but it's still holding on that trend line. All right, let's look at Ethereum, ETHUSD, and then we'll get into some of the individual stocks. All right, so Ethereum. Look at Ethereum. It's doing the same thing as Bitcoin. It is holding on to this trend line right here. Now, for Ethereum, the only time when we go back and look, we can go back to this area right here of June of 2021, and it dipped below the trend line that it's holding on to right now and came down to a price support of 1750. 1750. So now looking at Ethereum on this trend line right here, the candle is staying above it, but the wick is going below it. Today or this morning, that wick, it got as low as 29.28. So it broke that $3,000 level, and it's at 3,071 right now. All right, let's talk about some individual stocks here. First up is Generac. Ticker symbol is GNRC. Now, many of you may know we had a big snowstorm here in Northern Virginia, where I'm at, and that caused a lot of power outages. Generac sells generators. It also sells batteries like a power wall, like the power wall that Tesla has. Generac has their own. Now, today, and just a couple things to point out here on this chart. Once Generac fell out of this ascending trading channel that it was in, I put these two price lines in right here because they went back and matched this range right here that Generac was in. A bottom of, let's see, what is that? $290 and a top of $340. So back here, February to May of 21, it was in this range bound. Okay, it was moving sideways. So once it fell out, I decided, well, you know what? This would be a good area to put the lines because this is where it could come back to. Sure enough, it did. It actually came back to the top of that range and held up there for a while and then dipped below. Now, it's rising again. And today, it was up 2.2%. That candle wick today, it got down to $306, and it's at $323 right now. But Generac, the stock was up 2.2% today because UBS upgraded Generac to a buy as a long-term residential storage winner, okay? And when it's residential storage, they are talking about batteries, big batteries, like a Powerwall, like Tesla's Powerwall. Generac bounced off of a 7-month low today after UBS upgraded shares to a buy from neutral, and they upgraded their price target to $480 a share. Now, if we measure where Generac is at right now, 223, and we go up to $480. $480, just about there. That's a 48% ride. That's a 48% upside in Generac. And that 48% upside would put Generac almost back into the trading range that it fell out of. That's interesting to me. Generac is one of my favorite companies. Enphase, Generac, they kind of go together for me, both of them. But USB does see the company as well positioned to take share in the behind the meter battery storage market. Again, think of a Tesla Powerwall. Generac has their own Powerwall. And Generac also has a diverse product line, a dominant position in the home energy backup power market, and an established national installer network that gives Generac a key advantage in battery storage, particularly as incentive structures shift to benefit standalone battery installations and as more and more electric vehicles are parked in garages. More and more people will then be upgrading the electricity in their home in a way to charge their electric vehicles and to keep the lights on in their home. Now, Generac will see a boom in generator sales from the snowstorm that we just had here in Northern Virginia. In the local forums, there are many people in many different neighborhoods talking about, wow, the power was out for a couple of days for some people here. And we had very cold temperatures right after the snowstorm because this was the biggest snowstorm we have seen in 3 years. So there were a lot of trees with branches that hadn't been brought down in 3 years due to other types of snowstorms, ice storms. So all those limbs, the 3 years worth of branches and dead branches up in the trees, they all came down at once. So there's a lot of people in forums talking about buying generators for their homes. There are also people talking about the generator we had was too small for a home and we need to upgrade to a bigger generator. I've been seeing that talk too. So when people search for generators, who pops up? Generac. Generac is one of the most well-known brands for generators for whole home electric power. So they're going to get a boom in business right now. And that's usually the case for Generac. Usually, whenever there is some sort of natural disaster that knocks the power out for a while, then sales in Generac's generators goes up. So it's a similar pattern we have seen before. So this will help during this quarter for Generac. All right, moving off of Generac, I think it's a great company. It is on a discount right now from its highs, uh, over 50% off from its highs. That's a pretty good discount on a very solid company. Okay, let's go into the gaming space. Let's talk about the Take-Two acquisition of Zynga. All right, Take-Two, ticker symbol TTWO. And we'll look at this stock chart here together. Now, they've been on a very bumpy ride over the past year. Look at this. They could almost be range down. It would be a very big range, but we probably could get a low somewhere around the lowest point here is where it's at right about now, about 145. I'm going to put a line there at 145. And then I'm going to go up here and see where we can connect the dots. And it's probably right here around $188. Now that those two lines are there, it's a lot easier to see this range that they have been in. They've really been moving sideways here. Now, big gap down. They were down 13.1% today, and that took them to just under this range. Okay, big gap down. But if we go look at Zynga, and their ticker symbol is ZNGA, we're going to see the opposite of that gap down, a big gap up. 40%, 40.6% gap up for Zynga. They were down here, way down here, $8.38 this morning. That was their low. No, that's not right. Yeah, that is right. That's where they were this morning. So yesterday, though, yesterday they were lower. Let's see. Let me get that candle lined up there. Yesterday they were at $5.90, and right now they're sitting at $8.44 as we speak. So this big gap up right here goes to show the premium that Take-Two is paying for Zynga. Let's go back to their TTWO. We'll go back to Take-Two's stock chart here. Now, this gap down. They are still at $142 right now, which is just under, again, the bottom of this range that they've been on. They have earnings coming out next month. So Take-Two and Zynga are making a big splash in the M&A market. M&A just stands for mergers and acquisitions. So in the M&A market, as the two companies announce plans to merge in an effort to create a leading mobile game developer, Zynga, which has seen the price of its stock get halved over the past year, is surging on a $9.68 share cash and stock buyout offer, representing a whopping 64% premium on its closing price from last Friday. The maker of mobile games such as Farmville and Words with Friends was struggling mightily from an execution and financial performance perspective, evidenced by its 8 straight quarterly EPS misses. Therefore, the generous acquisition offer, valuing Zynga at about $12.7 billion, is a very welcome development for the company's investors. On the flip side, though, there's a healthy amount of skepticism regarding the merits of the deal from Take-Two's perspective. Its stock sinks, or it did, the stock sank sharply lower today. Considering the steep buyout premium, Zynga's I don't know. I don't know about this. Zynga's dismal. See, this is a big premium they're paying, and it just gets me. Zynga's dismal quarterly earnings track record and the fact that Take Two plans to take on additional debt to finance the transaction, the negative reaction is certainly understandable from Take Two investors and this big gap down today. However, I guess the merger does offer a few key advantages from a strategic point of view, including with increased mobility. Games are allocating more playing time to mobile devices rather than to at home gaming consoles. By combining with Zynga, Take Two will turbocharge its mobile gaming portfolio. The company estimates that mobile will represent over 50% of net bookings in fiscal year 23, compared to only 12% in fiscal year 22. This deal can also be viewed as an answer to Electronic Arts, EA, and the $2.4 billion acquisition of Glue Mobile last year, securing a more diverse and mobile leaning game lineup that's less reliant on core titles like Grand Theft Auto and NBA 2K. It should put Take Two in a better competitive position. Like Zynga, Take Two's quarterly results have been erratic and unpredictable. Revenue growth has ranged from a loss of 29% to a gain of 125% over the past 6 quarters. One facet working in Zynga's favor, though, is that unlike its EPS performance, its top line results have been solid and they've been steady. In fact, the company hasn't missed quarterly revenue estimates in at least 5 years. This consistency is related to Zynga's high level of recurring consumer spending, RCS, which will lessen volatility across quarters for Take Two. Although the premium over last Friday's closing price is significant, the total transaction, well, the value of Zynga is about 4 times next year's revenue. When considering that Zynga is expected to add $100 million in annual cost synergies within the first 2 years of closing, and at least $500 million in annual net bookings opportunities over that time, the purchase price does begin to look more reasonable. With Zynga shares trading well below the $9.68 a share acquisition price, it's clear that there's some doubt about whether this deal will receive investor blessings. The proposed deal isn't benefiting from a timing standpoint, either as the prospects of rising interest rates hang over growth stocks. Well, I can see the strategic rationale for the merger. Paying a lofty premium for a high risk asset like Zynga in this current environment is a tough sell. But what do you think about Take Two and their acquisition of Zynga? There's a lot of synergies and there is a strategic point of doing it. But the timing, is now the right time? Let me know in the comments what you think. All right, next up is Lululemon. I want to talk about them. And when I'm talking about Lululemon, I'm also going to be kind of talking about the whole of the retail market, because a lot of retailers came out today with announcements because of the big conference that's happening right now. It's the biggest retail conference of the year. Just give me a quick second here. Okay. All right, Lululemon, ticker symbol LULU. All right, so Lululemon, look at this fall that it has been in recently. This fall all started back here on November 19th, and it's been a really hard fall. And they were down 1.9% today. And they've got a bit of a green candle. Okay. And the reason it's down 1.9% and not more is there was some dip buying going on today. It actually got as low as $328. So a $20 difference there from its low today to its closing price. And it's flat in after hours. Okay. So I think Lululemon investors are turning a bit sour on Lululemon Athletica today after the athletic apparel retailer announced that it expects to close out fiscal year 22 towards the lower end of its Q4 guidance. This would translate to adjusted EPS of around $3.25 and revenue closer to $2.12 billion, coming in below estimates in both metrics. Although the stock was or has dropped by over 20% since late November, as concerns brewed that Omicron would materially affect Lululemon moving forward. The upgraded or updated guidance still comes back as a bit of a shock, especially given that somewhat bullish tone that Lululemon's adopted just a month ago. As of December 9th, Lululemon was pleased with its performance for the holiday shopping season, noting during its Q3 earnings call on that date that both its digital and physical channels were doing well. Digital, in particular, was smashing records in certain metrics. However, given Lululemon's updated Q4 guidance, things clearly began to turn quickly as the Omicron variant picked up, generating capacity constraints and limiting staff, which impacted operating hours. Given Lululemon's optimism surrounding staff availability, as detailed during its Q3 earnings call, that staffing issues contributed to the downside Q4 guidance. It comes as quite a surprise, as it does with many other retailers who came out today and lowered their guidance. In yesterday's Catalyst Watch video, I talked about these retail stocks and named quite a few of them because we were all under the impression from reports that came out that retail sales were strong. For some, it was. For others, like Lululemon, Abercrombie and Fitch, it wasn't. As of early December, Lululemon noted that its staff levels were well positioned for the holiday season. Remember how many associates Macy's hired? It had taken on an additional 7,000 employees, Lululemon that is, just to meet demand. Meanwhile, some of the capacity constraints may already have been mostly priced in. For example, in Q3, Lululemon expected air freight costs to impact gross margins by about 450 basis points for the year, up 250 basis points from the prior quarter. However, the possibility that these constraints could be contributing into Q1 could be putting additional strain on the stock today. Although Lululemon's factories in Vietnam were reopened in Q3, they were not operating at full capacity until then. Numerous apparel and home goods retailers such as Nike and Williams Sonoma also have significant exposure in Vietnam. Therefore, while Lululemon is not driving into, or diving, I should say, into further details, it is evident that a full recovery may take several months, most likely pointing to the end of March 2022. The main takeaway is that today's pronounced sell off and the results, which form a worst case scenario regarding Lululemon's Q4 guidance range, which could be setting up the company for further downside going forward. For example, Omicron is still causing a spike in COVID 19 cases, which could impact labor throughout the winter, especially when considering with the or coinciding, I should say, with the annual flu. Also, as Vietnam factories continue to ramp up production, capacity constraints may continue to pressure margins in Q1. Finally, when adding these headwinds to Lululemon's underperforming mirror segment, the mirror fitness, for which the company already cut its sales guidance in half, shares may continue to be under fire for the near term, perhaps magnifying the selling pressure. Lululemon also trades at a 1 year forward PE ratio of 38 times, a premium compared to Nike at 32 times and Under Armour at 21 times, and a fairly high multiple during a period of rising interest rates. I think these growth and high PE stocks are going to come under more pressure, more selling pressure. All right. So, what do you think about Lululemon, or what do you think about in general the announcements made from retail companies today? I'm sure there'll be more announcements tomorrow as well. Hopefully, they decided to maybe shock us with the bad news first and then hit us with the good news over the next coming days. Maybe that's their strategy. Okay, next up, I have got a 2022 stock idea for you. Commercial Metals. Ticker symbol is CMC. Commercial Metals. Now, when we look at this stock, it has been rising ever so slightly. Okay. It has these moments where there's a burst, a rally, a pullback, a burst, a rally, a pullback, rally, pullback. But it's moving up. If you notice, at least from September of 21, the low here versus the low that it made here at the end of November, this low in November is higher than the low from September. So it's moving in the right direction. However, though, it had this really steep run up here, February of 21 up until March of 21. And then it really started to slow down and move sideways. But now, when we look at it like this, we can see the slow, and let me mark this on the chart here. If I go like this and I connect these 3 points right here, you can see the uptrend. And then we clone this and put it up here at the top. There's 1, 2, 3 connections there. That's the trading channel it has been in. Okay. Now, this is the same slope on both lines here, but it does look like it's sloping out here towards the ends, and that's just the way the candlesticks are aligning themselves to make it appear that way. But they are equally spaced apart on both ends. Now that it's pulled back into this range, okay, I would suspect that if it continues moving lower, this 200-day moving average should act as support as long as this continues moving up, and I think it will. But if we look at every time it's touched the top or it has gone outside of this top resistance area, it's always pulled back, okay? And it's you got a 50-50 chance here. These first two, right over my head here, when they pulled back, bounced on the 50-day, rallied again, hit resistance, and then fell below the 50-day, but didn't come all the way down to this support bar. It moved sideways. Then it came down to the support bar. Up above, came down below the support. Up to resistance, straight down really to support, and then up to resistance, popped out of resistance, and then pulled back down. You can see the pattern now more clearly, right? Okay, but this is a 2022 stock idea. This is for the whole year. I think this company is going to do well. And let me give you my investment thesis. So, Commercial Metals, ticker symbol CMC, is a steel producer, but it is different from the better known names like Nucor, ticker symbol NUE, Steel Dynamics, ticker symbol STLD, US Steel, ticker symbol X, and so on. The main difference is that those other steel companies are primarily flat rolled steel producers. You probably have seen trucks with huge 20 ton, let me get that out right, 20-ton coral, big, big sheets wrapped up into these big coils on the backs of these trucks. That's flat rolled steel, which is used for automotive, appliances, HVAC systems, just to name a few. There are so many other industries that it's used in. They do also make long products, including wire, rods, bars, as well as structural steel, construction beams, railroad tracks. You get the picture. But flat rolled steel is their bread and butter. So here's why I like commercial metals for 2022 and not the other names in the steel industry. Unlike the other steel makers, commercial metals focuses almost exclusively on steel rebar. Rebar is used in construction and infrastructure projects like roads and bridges. Granted, you do not get a lot of in market diversification with commercial metals. But if you are bullish on the construction market for 2022, which I am, commercial metals is a good way to get high exposure to it. Commercial metals doubled, doubled down on the rebar construction market in late 2018 when it acquired the US based rebar steel mill and fabrication assets from a Brazilian steelmaker for $600 million in cash. The deal added 33 rebar fabrication facilities in the US. That is a lot of capacity. And I view this deal as commercial metals basically pushing its chips to the center of the table and going all in on rebar. That's right, all in. Construction is by far commercial metals' largest end market. And the best leading indicator is its volume of downstream project bids, which has increased meaningfully in recent quarters. Rebar is in very high demand, particularly in commercial metals core geographics. Commercial metals says people are moving in, businesses are investing, and state funded infrastructure spending is healthy, which is reflected in residential, non residential, and public construction spend data. Commercial metals also says Europe looks very similar to North American construction and the activity in both. And that activity is really strong. With new residential construction starts increasing by double digits in December of 21, Commercial Metals announced it will acquire Tensar for $550 million. Tensar should fit in nicely and expand Commercial Metals' exposure to the civil infrastructure market. Tensor sells geogrids, which are polymer-based products, used for ground stabilization, soil reinforcement, and excuse me, and asphalt optimization for roadways, public infrastructure, and industrial facilities. So they have a lot of uses. They also sell geopolymers systems, which increase the load bearing characteristics of ground structures. And it can be applied to soil types where traditional support methods are impractical. As you can see, and I'm sure it's a bit confusing when you hear it at first, but both companies are well positioned to benefit from any infrastructure spending that can occur. Plus, the deal embeds commercial metals closer with construction firms. I also like that Commercial Metals recently approved a 17% increase to its quarterly dividend of 14 cents a share. The resulting 1.5% dividend yield does not blow me away. It's 1.57% right now. It's not that big, but it's notable because it is Commercial Metals' first increase in 14 years. I see it as a sign that management has confidence in its business outlook. Also, Commercial Metals recently authorized a new share repurchase program of $350 million. That's roughly 8% of shares outstanding, which is a lot and tells me management thinks its stock price is attractive. To wrap this up, I like Commercial Metals stock and the stock action. It has been consolidating, trading sideways, in a slight uptrend between the $30 and $35 area for many months. But it's recently broken above that, as we looked at. That is an interesting chart setup. I think a further pullback, at least to the 50-day moving average, is totally possible. At that point is when I would start to add, or maybe start a partial position. Wait to see if it comes back down to the bottom of its range, and then go from there. All right, so that's Commercial Metals, ticker symbol CMC. I think it's a good idea for 2022 because there's going to be a lot of construction in 2022. And rebar is very important in construction. All right, let's talk about catalyst for tomorrow, Tuesday. And this is with AMD. I know there's been a lot of questions lately about AMD and the deal with Xilinx. Now, look at AMD today. It ended up flat today on the chart, but it was down. Got to a low of 125, and now it's at 132. So it bounced back nicely. But AMD, and the reason I have it on for tomorrow, January 11th, as a catalyst to watch, the HSR deadline for AMD's planned purchase of Xilinx expires. It expires. The deal is awaiting approval from Chinese antitrust authorities, according to AMD. And if AMD does not get approval by tomorrow, then AMD must file a new HSR filing because tomorrow's the deadline for it. Now, if AMD does not refile, then that could mean the deal is dead. But I don't think the deal is. I don't think I don't think the deal is going that way. I think there's benefits for AMD to have Xilinx. So it's a catalyst watch for tomorrow. Look for more volatility if the deal is extended again, because remember, in late December, AMD and Xilinx, they pushed the deadline for the deal out further, and they pushed it out to now, or tomorrow, I should say. So watch for that. If there's no extension, if there's no deal, or maybe they announce the deal is not going to work, watch for news for AMD tomorrow, because it could really influence the stock. Then also Xilinx. Watch out for Xilinx as well. Their ticker symbol is XLNX. Now, they've been moving in a very, if we overlay AMD and Xilinx stock chart here, it would look nearly identical. They've been moving in lockstep together here, just about. But watch Xilinx also. This one could move as well. If the deal doesn't go through, then maybe the stock could sink, because investors are like, oh, well, if the deal's not going through, because back here, there was this big red candle back here, December 16th. It was down 8.2% on one day. That's when it was announced the deal was being pushed back. Investors for Xilinx didn't like that very much. So you can watch Xilinx as well, and AMD also, for that news on their acquisition tomorrow. That's really the only big thing that I'm watching for tomorrow, because I'm really waiting for Wednesday and the CPI report. All right, well, we'll wrap it up here. If you found this video to be helpful, informative, actionable, then click the like button. Next, take the URL and share this video wherever you can. And then third, click the first link in the description. Get our top 10 value, growth, dividend, momentum stocks. They are constantly updated so we can all reach financial freedom. So that'll be it for today. I will see you back here tomorrow at 5 p.m. Eastern, so we can talk about the market, stocks, and most importantly, what's on your mind. So, ladies and gentlemen, thank you so very much for watching, and I will see you in the next video.